Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy.
Good morning, everybody. We have a new format from what I see in Zoom anyway. It's an update. So if I seem a little disjointed, that's why. I'm getting different signals than I did before. But good morning. It is Tuesday morning, July 27th. It's our Tuesday morning webinar. It's 10 a.m. We've got a few things to go over with you today. I'm going to, of course, talk about some market updates from the last week and give you some analyst thoughts from what I'm seeing from my analyst reports. And then we're going to go over a financial planning topic. And today's financial planning topic is going to be revocation on divorce. And specifically, there's a new piece regarding affinity. So I'll talk about that. But that is revocation on divorce is broadly when you name a ex-spouse or a spouse as beneficiary, and then you divorce that spouse, what happens to your beneficiary relationship? That's changed since 2018. So, and of course, then there's changes, case law updates since then. But we're going to talk about that a bit for our financial planning today. Okay, so let's talk a bit about our Ed slot updates. So these are the mailbags and the slot reports that I get throughout the week. And they're always good. And sometimes it's hard for me to winnow it down. But this week, again, is from Sarah Brenner. And the question that came in is, if you are an employee who participates in a 401k who retires at age 73, do you have to take an RMD in the year you retire? Or can you take your RMD by April 1st of the year following retirement? If you can take your RMD by April 1st of the year following the following year, does that mean you have to take two RMDs in that year? So RMD obviously is required minimum distribution. This is the amount that the IRS tells us we must take from our retirement accounts, whether they're IRAs or retirement plans. Now, remember, I don't want to get into the details of it because they're many and detailed, but retirement plans, 401ks, 403bs, and such, have different rules than IRAs. So you always want to remember that. You don't want to try to combine the two. So this person's asking, and this is an example of this, they're still working and he or she is 73 years old and they have not yet taken an RMD out of their 401k, and that's okay as long as they're not more than a 5% owner of the company. They can do that. They can delay those required minimum distributions. But this person asks, in the year I retire, then what happens with my RMD? Great question. We get those kind of questions all the time. Sarah writes back, if you are still using the still working exception to delay RMDs from your plan, your retirement plan, not your IRAs, if this person had IRAs and a 401k, then that person is going to have to take the RMDs out of their IRA, but they can delay out of their 401k if they're still working and not more than a 5% owner of the company. So Sarah says, if you're using that exception for your retirement plan, your 401k, you must take an RMD for the year you retire. So once you retire, even if you retire right at the end of the year, you have to take an RMD for that year. Now, taking an RMD for that year doesn't mean it has to be in that year in the first year. You can delay the first required minimum distribution until April 1st of the year following the year you retire. However, if you do delay your first RMD until the following year, you of course will need to take two RMDs in that year, because the typical calendar tells us by 12/31, December 31st, every year, we have to take our required minimum distributions, whether they're from 401k plans or IRAs. If you delay your first RMD, whether it's from a retirement plan or an IRA, you can do that. You can delay it until April 1st of the year after the year you retire, or the year that you turn 72. Now it used to be 70 and a half. You'll of course have to take two in that year, because you're taking the one you're taking on April 1st is for the previous year. The one you're taking by December 31st is the current year that you're in. So good answer, by good topic. Often comes up. RMDs are confusing. And you don't want to miss with an RMD because you probably know what is the penalty for failing to withdraw your required minimum distribution. That's right. It's 50% of what you should have withdrawn. So let me just check in. I see a question here. Oh, Walter's answering my question. 50%. Very good, Walter. Thank you. Okay. So the next question is about inherited IRAs. And this is a good one too. Inherited IRAs have a lot of limitations, but here's a limitation they don't have. Judy writes, could you answer this question? Can I establish a new inherited IRA at one custodian? And if I'm not satisfied with that institution, can I then transfer that inherited IRA to a different institution? So you should know that you often have choice. There are organizations out there that make it very difficult to have choice, and TIAA, you've heard me talk about it, is one of them. TIAA makes it very difficult to move assets around. They greatly limit what you can take out of accounts, at least some of the accounts from some time ago. I'm not sure exactly how they are today, but we have people who have accounts in TIAA CREF, and they have significant amounts of money. They can only remove 10% a year out of that, even if they're over retirement age. I have clients in their 70s who can only take 10% a year out of their plan. So let me get off that soapbox. But in this case, if you would like, we currently custody with Fidelity. So if we take an inherited IRA and move it to Fidelity, and for some reason the client doesn't want to keep it there, well, he or she can move it to another custodian. There's no issue with that. What they cannot do is take the money out and redeposit it into a beneficiary designated IRA. They would want to do a custodian to custodian transfer. As long as you are doing custodian to custodian transfers, there's no limit on that. It's where you run into trouble with regular IRAs is when you take the money out and you try that 60-day rollover rule, but there is no 60-day rollover rule for an inherited IRA. Once that money comes out, it cannot go back in. So the answer that Sarah writes is, Judy, it is possible to move inherited IRA assets from one IRA custodian to another, but it must be done correctly. You can only do a direct trustee to trustee transfer from one inherited IRA to a new inherited IRA. Be careful here. The funds must move directly. A non-spouse beneficiary cannot do a 60-day rollover. I just said this. If the funds are distributed to you, you will not be able to put them back in an inherited IRA. And this is a mistake that cannot be fixed. That's true. A lot of these distribution issues, the IRS doesn't let you put money back into the accounts. Once you remove them from the protection of the IRAs, they want their tax, and they're not going to let you take it back out. All right. The next bit is about HSAs, so health savings accounts. Many of you have health savings accounts. So Sarah listed 5 benefits of HSAs that may surprise you, she writes. And she talks about HSAs. The accounts have been around now for a while. They work with high deductible health insurance and are known for the triple tax benefits. Contributions can be deducted, so you get a deduction going into it. Earnings are tax deferred, and while in the HSA account, and if HSA funds are used for qualified medical expenses, both contributions and earnings are tax-free when distributed. While you may know the basics, here are 5 HSA benefits that may surprise you, she writes. There are currently no income limitations for HSA contributions, and you do not need to have earned income to contribute it. So they're not like IRAs or Roth IRAs. As long as you have a high deductible plan, you can contribute. I'm not sure how you could have a high deductible plan and no income because they're employer plans, but I'm not going to, there must be a way. As long as you have an HSA, high deductible health insurance, you can make a HSA contribution for the year. No one makes too much to contribute. Unlike an IRA, there is no requirement that you have earned income to be eligible. Number 2, if you make an HSA contribution, currently you may deduct that contribution regardless of how high your income is. Everyone who is eligible to make an HSA contribution can deduct it currently. No one makes too much money to take the deduction. It never phases out or goes away, even for the highest earners. That is quite unusual. With a Roth IRA, if you make too much money, you can't contribute to it. With a traditional IRA, if you make too much money, you can contribute to it, but you can't take the deduction for it. Number 3, you can take tax-free distributions from your HSAs for qualified medical expenses, including those of a spouse or dependent. This is true even if your spouse or child is not covered under the HSA compatible, high deductible health insurance. Your HSA can benefit your family members. This is true even if they do not have high deductible coverage themselves. Interesting. I don't know if I remembered that. So that's good, Sarah. So you can cover a spouse or dependents. You can take tax-free. Number 4, you can take tax-free distribution from an HSA to reimburse yourself for qualified medical expenses in prior years, as long as the expenses were incurred after you established your HSA and you have proof of those expenses. There is no requirement that the expense and the HSA distribution take place in the same year. In fact, the distribution could happen years later and still be qualified tax-free distribution from the HSA. Number 5, you cannot contribute to an HSA once you're enrolled in Medicare. However, you can keep your existing HSA and you can still take tax-free distribution for qualified medical expenses. Many people are unaware of these rules and mistakenly believe HSAs cannot be kept past Medicare enrollment. That's true. I've heard that. I can't even tell you how many times. That is not the case. You can keep your HSA and you can continue to tap into it to pay your medical bills. Great information as always from the slot group. And let me just clear this question. I know Sarah is not listening, but if you ever do listen to this webinar, Sarah, thank you very much. I haven't talked to Sarah in a couple of weeks, so I'm sure now I'm going to have a reason to call her. All right, let's talk about the markets last week. So the week ending July 30th, 2021, the Dow Jones was down slightly, the S&P was down slightly, the NASDAQ was down more, about 1%. Pretty either down slightly or slightly up across the board. Still strong numbers for the year, 15.3% for the Dow, 17.98%, almost 18% for the S&P 500, 14% for the NASDAQ. So honestly, folks, if we just stayed right where we are so far for the year, I think everybody would be happy with that. Now, surprisingly, interest rates went down again last week. Prior week, the 10-year Treasury was at 1.28%. It closed on July 30th at 1.22%. Really surprising that interest rates continue to be down. You know, the Fed, I think it was last week they had their meeting, maybe the week before. They reiterated their positioning on interest rates and their monetary policy. So no changes to be seen there. So there's been a lot of talk about inflation over the past, coming up on a year now. I guess last July, BlackRock started talking about the concerns about inflation early on, and then everybody else kind of piled on eventually throughout the year. And now we're seeing it, we're living it, we're in the middle of it. There's a lot of concern about higher inflation. This week, the big topic was China. So BlackRock, I'll just read this to you. BlackRock reports from their analysts that China's regulatory clampdown on industries such as tutoring and tech has unnerved global investors. So we've seen some fluctuation in the China markets. We see little global spillover risk from China's assertion of greater control over certain industries, even as it potentially leads to market volatility. This is BlackRock's position. They remain tactically neutral on China stocks, which simply means they're not overweighting it or underweighting it. They're staying with their typical allocation, and see further monetary and fiscal policy loosening as beneficial for cyclical assets in China. They go on further to say this does not imply a fundamental shift in the regulatory policy stance in our view. We believe that the regulatory clampdown will likely go on for years. So this clampdown on, as I talked about before, in industries is tutoring and tech. They think this is going to go on for years, yet its intensity will fluctuate. China's leadership sees regulatory tightening in sectors such as tutoring and technology is necessary to rein in the industries that have been rapidly growing and lightly regulated, which has led to concerns about control of data, inequality, and the rising cost of education, housing, and healthcare. So their bottom line, as I said, they remain neutral in China equities tactically, but are seeing opportunities emerge in sectors that benefit from monetary easing or are less prone to regulatory tightening. Okay, so that's really the bottom line for BlackRock. They're, so you're starting to see some comments about China. And in fact, Riverfront, another group that I like to follow, is talking about China also. And their headline was hot summer, but an increasingly cold war. Chinese stocks under fire, but issues largely isolated to China. So their key takeaways, and I like the way they do their key takeaways. There's 4 bullet points that we have. They write, we believe that recent Chinese offshore stock sell-off is unlikely to be the catalyst for the end of the U.S. stock rally, in our opinion. That's an interesting point. A lot of folks are concerned that we've had this strong recovery. Now we have, and stocks, I just read you the numbers, 15%, 18% for the year, 40%, 35% from where we were last year. These are big, big numbers, especially in the environment that we've had, but we have economic concerns we have in the US and globally, but certainly in the US, we have economic concerns. We have inflation concerns. We still have an unemployment issue, and it's not a lack of jobs. It's a lack of people filling those jobs. So we have, what we refer to as headwinds and strong headwinds. So we'll have to see, and then everyone's concerned about what's coming out of Washington or what's not coming out of Washington. So, many people are concerned about higher taxes. They're concerned about increased regulations. So there's a lot of concerns economically. So China appears to be prioritizing social stability and political aims over shareholder protection and corporate profits. We see the episode as emblematic of the new Cold War, they're calling it, between US and China. In May, we trimmed holdings. So now remember, BlackRock is staying neutral. Riverfront is noting that in May, they trimmed weightings to Chinese shares in our balanced portfolios and prefer US and European shares. So, these tactical moves are always to be seen. They might come out to be the smartest people in the room, Riverfront, or maybe BlackRock is, that's yet to be seen. Prudential is still talking quite a bit about inflation. And they write, there is accumulating evidence that the U.S. economy could be at the early stages of a new inflation cycle as measured by the Consumer Price Index. Core consumer inflation has nearly tripled in the past 3 months, from a low of 1.3% in February to 4.5% in May. And in certain areas, it's much higher than 4.5%. An analysis of underlying economic and policy trends strongly suggests that the fundamental conditions that typically precede a sustained outbreak of inflation have begun to materialize. Most notably, monetary and fiscal policy conditions, the 2 primary drivers of long-term inflation, have been highly inflationary over the past 18 months. So Prudential is again cautioning about this higher inflation cycle and that it's going to be here for some time. The key question for investors, De Lucia writes, is the extent to which high and rising inflation is relevant consideration for asset allocation. Oh, of course it is. Based upon traditional finance theory, the answer is a resounding yes. Thank you. I did read this before. It's just been a little bit. I think I put this in yesterday. An analysis of returns during previous periods of steadily rising inflation confirms the powerful influence of inflation on financial asset returns. So what does that tell us? Well, should we overweight China, underweight China? Should we stay static or neutral as BlackRock? We got all these strong analysts. Should we be focusing on inflation? Should we be focusing on any areas? And the answer is all really yes. We should be focusing on all, but how do we handle it? We handle it with, remember the 3 pillars: asset allocation, principal protection, and account segmentation. And I'm going to start adding in there guaranteed income. Because whether it's a pension plan, whether it's just your Social Security, whether it's sale of a business, rental income, or some kind of guaranteed lifetime income from an annuity, it's helpful to have that base to be able to give you that, really that base. It goes back to that foundation. You want your foundation. So asset allocation, principal protection, account segmentation, and really guaranteed income comes from more of a planning perspective, not so much an investment perspective. But if you hit at least those 3 pillars, asset allocation, principal protection, and account segmentation, and keep those up to date and monitored, you can listen to all this that we hear from analysts and pay attention to it and know what's going on and rely on someone like me to do that for you. But as long as you have that foundation in place, as I said, you might get some disturbance, but your building shouldn't collapse. Your retirement shouldn't collapse. So with that, I'm just going to reiterate that we are defensively optimistic. Listen, again, if we just stay where we are now for the rest of the year, I think if we close out the year, The S&P 500 up 14%, the NASDAQ up 15% or wherever it was. I think everybody would be very happy with that. All right, so let's talk about, let me pause and see if there's any questions about that. Somebody wrote, well, now chat's supposed to be disabled. I'm gonna have to go and check my things. What happens to an inherited IRA? Does the money have to be withdrawn by the beneficiary? Someone writes. Yes, yes, an inherited IRA, the money has to be drawn by a beneficiary. So there's a couple different types of beneficiaries. There's a eligible designated beneficiary now under the Secure Act. And off the top of my head, they are surviving spouses, a person not more than 10 years younger than you, disabled, a disabled individual or a disabled child or a minor child. And there's probably one more that I'm not remembering off the top of my head. But though anybody who, so any of those folks can treat the IRA as, well, the spouse, excuse me, can treat the IRA as his or her own. Any other ones can do the common stretch IRA, but there's still distributions that have to be taken in those cases. So if you cannot treat the IRA as your own and it is an inherited IRA, then you must take distributions. Now, the new Secure Act says that you have to take those distributions by the end of the 10th year. If you choose to do, if you're an eligible designated beneficiary and you choose to do the old lifetime table projection, which means you can take it over your lifetime, then you're going to have to take required minimum distributions each year. I hope that answers your question. We have a really good turnout today. It's good to see everybody. I just caught the number of folks dialing in. You know, it grows and grows every week, and I appreciate that. So let's talk about revocation on divorce. And if the chat is functioning, ask your questions, please, in the Q&A, just so these don't get pulled out when the compliance review does this. So what is revocation on divorce? I was doing some research for a client issue, and I came up. I was in the slot manual from our spring training this past spring, and there was a really good portion on revocation of divorce. So revocation on divorce it simply means that when you have an ex-spouse who is designated as a beneficiary, and this is probably one of the most common issues prior to this case or this decision in 2018 from the U.S. Supreme Court, and that was an individual has their spouse on their IRA, life insurance policy, their 401k, and then they get divorced and they never change that beneficiary designation. And then they die, and their ex-spouse gets the funds, and that was often an issue. You can just imagine. Person gets remarried, doesn't change that divorce, beneficiary designation, and the money goes to the ex-spouse. So I don't have any statistics on it, but probably one of the most common beneficiary issues was this ex-spouse issue. So in 2018, there was a court decision, and in June, and it was an 8-1 ruling. I don't know who the dissension was, but they concluded that life insurance proceeds would not go to an ex-spouse, even though she remained the beneficiary in this case. She remained the beneficiary on the beneficiary form after the divorce. Instead, the U.S. Supreme Court ruled that the Minnesota state statute, and that's where the case was originally contested, removing an ex-spouse's beneficiary upon divorce was constitutional. So Minnesota had a statute that said after divorce, basically that ex-spouse doesn't matter. It goes to the contingent beneficiaries. So they ruled that that statute was constitutional. The contingent beneficiary received the proceeds. Then later in October of that year, the Alabama Supreme Court heard a similar case involving an ex-spouse making a claim on a life insurance policy. Despite the fact that the divorced couple had reconciled and planned to remarry, they had even repurchased the original wedding rings, they write. The Alabama Supreme Court, citing the U.S. Supreme Court ruling, concluded that the ex-spouse's beneficiary designation was revoked by virtue of the divorce. So that changed things for financial planning. And many people thought, okay, well, maybe that's something I don't have to worry about because now we have these rules that is this revocation on divorce. But be careful. there's no harm in going back and changing your beneficiary designations. And it's something you should review every single year. I have to tell you that people are always, whenever we review these things, many times people say, well, yeah, I've got that all together. And then when we look at it, they say, well, let's do it this way, or I thought it was that way. And we make sure it's up to date. And sometimes the custodian just has it wrong. That happens too. These custodians, think about it. Fidelity is the largest provider of 401k plans. They have a lot of paperwork they're dealing with, and not all the time is it right. I've seen it with Fidelity. I've seen it with everybody. So you can't count on these things. And this list from 2018 is 26 states, and I don't know if any other states have been added to this. Certainly Pennsylvania and New Jersey are on here. If you have any questions about if your state applies, you can look it up online, or you can contact me and I'll get an answer for you. But obviously it's a little bit better than half, just a little bit. But there was an update past August, almost a year ago today, that was in this this manual I was looking at last week that I thought you would find interesting. So pretty cut and dry, the revocation on divorce. It says if you're divorced, you're no longer the primary beneficiary, goes to the contingents. Well, in the Arizona Court of Appeals on August 6th of last year, 2020, there was the Podgorski case. So this is titled "Affinity is Stronger Than Marriage." Now, this is interesting. So this was Podgorski versus Jones, and this is all public record because it's in the courts. And this is about a stepfather's bequest to stepchildren, and it's not voided by the state revocation on divorce law. So this is going to get a little complicated. I think it's good for me to read these things to you, and I'll try to explain it as we go. But just stay with me, and I'm going to put my full-size view up here on my right-hand side. So raise your hand if you need me to restate something before we move on. Okay, so an Arizona appeals court ruled that the state's revocation on divorce, remember I just explained it, what that is. So Arizona has a revocation on divorce case. The US Supreme Court says that's the end of it, right? We agreed with the original case. If there's a divorce, the ex-spouse is out, even if the person doesn't change the beneficiary form. And that's the rule in 26 states. Right now, because the U.S. Supreme Court didn't say that applies to everybody. It just supported the revocation on divorce statute in each state. So now Arizona has this revocation on divorce law, and the appeals court in Arizona says this law does not nullify the bequest of an individual's estate to his stepchildren when he died after divorcing their mother. The court said the Arizona law does not revoke a disposition made by a person to a former spouse's relative who remains related to the person by affinity after divorce. In this case, there was evidence that the stepfather maintained an affinity relationship with the stepchildren following his divorce. So these folks were married, Ronald and Patricia Podgorski. They married in 1987. Patricia had 2 children from a previous marriage. And when she married Ronald had no children of his own, but he did not adopt Patricia's children. So no adoption, they were just his stepchildren. Ronald and Patricia created a revocable trust in 2007. So husband and wife created this revocable trust in 2007, and Ronald executed a will at the same time. The will left all of his estate to the trust, and the trust named his stepchildren as sole trust beneficiaries and co-trustees. Ronald and Patricia divorced in 2016. Neither the will nor the trust was revised after the divorce. So they get married in 2007. They set up a revocable trust. The kids are, Ronald's stepchildren are the sole beneficiaries and co-trustees of the trust. So Patricia's not even involved in it. They divorced in 2016, and Ronald did not update his trust or will. So Ronald dies in 2018. Krista, that's one of the children, was appointed personal representative of the estate. Ronald's siblings now, so Ron dies, one of the children is appointed personal representative. She's also beneficiary of the trust and co-trustee of the trust. Now Ronald's siblings, They went to court to remove the Krista, the stepchild, as personal representative and to remove the stepchildren as co-trustees of the trust. The siblings contended that Arizona's revocation on divorce statute nullified the will and the trust. They're saying there's this law in the books, and now the Supreme Court has said it's constitutional. That kicks everybody out. That would leave the siblings to inherit under the state's intestate law, which establishes the intestate laws establish who's going to receive assets in absence of a will. So the lower court in Arizona found in favor of the stepchildren, and Ronald's siblings appealed to Arizona Court of Appeals. So here's the court's decision. It's interesting. The Arizona Revocation on Divorce Law, ROD law, provides that a divorce or annulment generally revokes any grant of property made by a divorced person to that person's ex-spouse or to any relative of the ex-spouse. So just reading that, you would think the kids are out. The law defines a relative of the divorced person's ex-spouse as someone who is related to the ex-spouse and who, after the divorce, is not related to the divorced person by blood, adoption, or affinity. So again, reading that, they're not related by blood. He didn't adopt them. What about this affinity? The Arizona law does not define affinity. Under prior Arizona court decisions, the term was defined as a connection existing in consequence of a marriage between each of the married person and the kindred of the other. However, no prior Arizona court had addressed the issue of whether an affinity relationship created by marriage may continue to exist after divorce for purposes of Arizona ROD law. All right, let me pause. I see a question. Oh, Gerard, so Gerard's got a question about SSI. Let me come back to that. In Podgorski, the appeals court decided that the plain language of the Arizona law contemplates that an affinity relationship can survive divorce. So remember, not related by blood, not adoption, but the question is there an affinity relationship? The appeals court decided that the plain language of the Arizona law contemplates that an affinity relationship can survive divorce. So just raise your hand if you're with me. Are you with me so far in this? I know it's complicated. Excellent. Thank you. So there's some, all right, I'll read you what the court said. The plain language of the statute contemplates the possibility of the affinity relationship continuing after a marriage ends. This is what the court writes in their opinion. As noted, the statute defines a relative of the divorced person's former spouse is a person who is related to the divorced person's former spouse by affinity and who, after the divorce, is not related to the divorced person by affinity. If all affinity relationships created by marriage terminated and automatically upon divorce, the legislature would have had no need to include the additional statutory language. And who, after the divorce, is not related to the divorced person by affinity. So they're basically saying that if the legislature intended for it all to stop after divorce, they wouldn't have added that and affinity. So let's see where that goes from there. The appeals court rejected the siblings' arguments that the clause "and who, after the divorce, is not related to the divorced person by affinity" was intended to apply only to relationships by affinity created by marriages other than those between the divorced person and the ex-spouse. Several cases were cited by the siblings as support for their contention that dissolution of marriage automatically terminates an affinity relationship, but none of these cases had interpreted the Arizona ROD law at issue here. The siblings also cited a Ninth Circuit decision, so that's a federal appeals court decision that barred courts from considering evidence to determine whether the decedent intended the divorce to change his bequest. However, that decision did not concern an affinity relationship. So all the case law that they brought up didn't answer the affinity question. The appeals court adopted the lower court's finding, we're getting there, finding that the stepchildren remain related to Ronald by affinity after the divorce. Even the siblings did not dispute that Ronald continued to treat the stepchildren as his own children following his divorce and until his death. For example, after the divorce, Ronald named the stepchildren as the beneficiaries of his 401k account and continued to make monthly payments on a term life insurance policy that named the stepchildren as contingent beneficiaries behind Patricia. So that is very important. Ronald kept this relationship. He named them as beneficiaries of his 401k. He continued to pay life insurance that had the stepchildren as beneficiary. Since Ronald's affinity, and he maintained a relationship with him. Since Ronald's affinity relationship with his stepchildren survived the divorce, the Arizona ROD law did not revoke the provisions in his will and trust, leaving his entire estate to the stepchildren. So this is really interesting to me, and I hope it's interesting to you. And here's the takeaways on this. So don't get caught up in this. Don't allow yourself to be a court case. Let's be clear about it. There's nothing. Listen, if you've got a situation like this where you're divorcing, but you still want to take care of non-related individuals, there's nothing wrong with updating your beneficiary forms to include those individuals again, even if it's the same, and signing and dating it anew. Nothing wrong with that. Nothing wrong with talking to your attorney and maybe drafting something within your will that just affirms it. So it's so you're not going to get caught up in a court case, because, you know, I was speaking with someone yesterday. It was a new potential client who came in, and she's in her 80s, and she's trying to figure out how to get her hands around what she's developed, what she's grown over the years, which is significant. And she has several kids, and as usual, one of them is power of attorney, trustee, and all these different things, executor. And these kinds of issues can destroy families. We see this. So the clearer you are in your wishes, the better chance that you have of not disintegrating family relationships. It's not foolproof, but when you rely on things like ROD laws or just, intestate laws, I won't be here. I hear people joke about that. I won't be here. They'll sort it out. Well, they may sort it out within a family civil war, and sometimes it ends up in court, and that's not good for anybody. Court's the place you don't want to be. It's, nobody comes out a winner. So as of June 2018, as I said, 26 states have adopted ROD laws. The U.S. Supreme Court in Sven versus Mellon found such, or maybe Meelan, found such laws constitutional when it upheld the Minnesota ROD. The court allowed the proceeds of Mark Sven's life insurance policy to be paid to his children from a prior marriage instead of to his divorced wife, his primary beneficiary. This does apply to IRAs by indicating, by indicating that the Minnesota ROD law would apply to life insurance policies or similar assets. So in the opinion, the Supreme Court wrote similar assets in the Sven case. That signaled that those laws could apply to non-probate assets such as IRAs or company plans or potentially annuities. Following the Sven decision, the Supreme Court let stand a Ninth Circuit Court of Appeals decision that had applied the Arizona ROD law to an IRA beneficiary designation. So it's not just life insurance. It can also be IRAs. It can also potentially be, it's not talked about here, but annuities, because that's also a non-probate asset. All right. Whew, goodness. So that's a lot. Let's see if we can tackle Gerard's question here now. Let me bring you folks back down here, so I'm not looking sideways. So Gerard writes, how may you pass assets to a beneficiary niece that is on SSI without impacting her eligibility for benefits? Gerard, that's a really great question for a good estate attorney. So what most people do is they set up something called a special needs trust, and that allows you to fund a trust for someone who is on disability. And if it's funded and structured the right way, they can still get the benefits that they need to get from the government. Good question. All right, so that was I thought a perfect piece of information for you folks today, the ROD laws. And if you take nothing else away from that, take away, let's say, at least two things. First of all, you got to stay up on these things all the time. That's why it's important that, this continuing education I do through the Slack group, and now even David McKnight, he's always given us great information. And so, but certainly Ed, I'll be back. I think October, I have to go to St. Louis. Now it'll be hopefully still a live event for the Ed Slot updates. So we do that twice a year over 2.5 days, depending on the program. There's a lot of information. So this manual sitting in front of me is 357 pages. There's a second manual that's probably about half of that. So we go over 450 pages of case law updates and things that affect you. This stuff's important. It's not about just knowing everything, right? So I read through this in the springtime. I was doing some research, reminded me, but it's knowing that trigger in the back of your mind that says, hey, this is something we should pay attention to. It's so important to review everything every year. Doesn't mean you have to change everything every year, but you should review it every year. Review your beneficiary designations. Review, of course, your income, your expenses, your assets, how things are flowing. The financial plan should be completed and then constantly monitored. There's days of creating a financial plan, printing up a couple hundred pages, putting it in a pretty binder, and then putting it on your shelf. They're just gone. First of all, that was obsolete when it was done that way. Now we're fortunate enough where we have everything living and breathing through these secure portals, and we work on these on a regular basis. We update them all the time. I would say that we do, I don't know, 8 to 10 hours of updates on every plan every single year before our financial planning process for each client. So that's a lot, and the clients know it's a lot because they're living it, one-on-one. They update those sheets for us. They review their financial planning questionnaire. It's really, really important stuff, but it helps save things like this. I don't ever want to see one of my clients have to go through court because of something that could have been easily resolved and taken care of. All right, seeing no other questions, I'm going to wrap up for today. Remember, no webinar next week. Mark will be on vacation. We'll be in West Virginia having some hiking and rafting time, and we'll be enjoying that. So enjoy the rest of your week. Enjoy next week, and we'll see you the following Tuesday, which looks like it's the 17th. If you need to make time in my calendar, that's going to pop up when this webinar is over, and I'll see you then. Thanks. Have a great week. Take care.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.